That 30-day grace period on your mortgage, it's not protecting you. It's the trapdoor your lender built into your credit profile. I'm Jonathan Reed, and I've spent the last 15 years building a real estate portfolio across 30-plus rental properties with millions in assets under management. In that time, I've watched smart, disciplined investors and homeowners get absolutely blindsided by grace period mechanics they didn't understand. Last year, I reviewed a client's file right before they were about to close on a $2 million commercial investment property. Their credit score had dropped 127 points in 6 months. Why? They used their mortgage grace period twice. And it cost them not just credit points, it cost them a quarter-point rate increase on that deal, which adds up to $127,000 in additional interest over the loan's life. That's what we're talking about today, not theory, not generic tips. The actual mechanics of how grace periods work, why lenders engineered them this way, and what it means for your financial future. Let's start with the basics, because I've found most people, even experienced investors, get this fundamentally wrong. Most homeowners think a grace period works like this. Your mortgage payment is due on, let's say, the 1st of the month. If you pay by the 30th, you're good. No late fee, no credit hit. Simple. That's what the marketing materials suggest. That's what feels logical, and that's exactly what lenders want you to believe. Here's what actually happens. Your mortgage payment becomes due on the 1st of the month. This is the contractual obligation date. If you don't pay by the 1st, you're technically in breach of your loan agreement. That's day 0. Then the grace period kicks in. Most mortgages come with a 15-day grace period, though you'll sometimes see 10 days. This grace period exists ostensibly to protect you. It means the lender won't charge you a late fee if you pay between the 1st and the 15th. But and this is critical, that grace period is not the same as on time. Your payment is still late, it's just a grace period. When does this hit your credit? Here's where most people get it wrong. Many borrowers believe they have until day 30 to pay before any credit reporting happens. I've heard this from clients dozens of times. My mortgage broker said I had 30 days before it affected my credit. That's not how it works, and that misconception has cost people serious money. Credit reporting happens on day 30, but not in the way you think. The credit bureaus Equifax, Experian, TransUnion don't wait until day 30 to mark you as late. Lenders report you as 30 days late once you've reached day 30 of the billing cycle. That's a major credit event. A single 30-day late payment can drop your score between 70 and 135 points, depending on your starting score and credit history. I've seen it drop 120-plus points for borrowers with previously pristine histories. But here's the trap within the trap. You don't have to reach day 30 to see damage. Many lenders start reporting delinquency data to credit bureaus around day 25-28, depending on their internal systems and reporting schedules. So by the time you realize you're in trouble, the damage is already being reported. In my experience, this is where grace periods become weaponized. The lender has engineered a system where they give you 15 days before charging a late fee, but they've constructed the credit reporting timelines so that your credit takes a hit well before you'd naturally expect it. Let me walk you through a specific situation I worked through last year. A client, solid borrower, 780 credit score, clean history, had a cash flow hiccup. His tenant at one of his rental properties went dark on rent. I'm talking completely disappeared. Meanwhile, his mortgage payment was due on the 1st. He had the money in his main account, but it was tied up in an escrow dispute, so he didn't pay on the 1st. No problem, he thought. He had 15 days before the late fee kicked in. He was planning to resolve the escrow situation by day 12. What happened? By day 25, the lender had already reported him to the bureaus as 25 days delinquent. His credit score dropped 103 points overnight. He paid on day 26, well within the grace period. No late fee was charged, but the credit damage was done. Why does this matter? Because he had a rate and term refinance scheduled for 3 weeks later on his primary residence. His credit score had dropped below the 760 threshold required for the best rates. He went from a 3.2% rate to a 3.65% rate. On a $650,000 mortgage over 30 years, that's $142,000 in additional interest. That's not a hypothetical. That's a real client, and it all stemmed from using a grace period he thought was there to protect him. Now let's talk about why lenders structure it this way, because this is important context. From a lender's perspective, the grace period serves a specific function. It reduces their administrative burden and minimizes their legal liability. If they charged late fees the moment a payment was late, they'd face regulatory scrutiny. They'd also have to staff up to handle thousands of disputes and exceptions. By building in a grace period, they create a buffer that looks customer-friendly on the surface, but actually works in their favor operationally. The credit reporting, though, that's where their true interest lies. By reporting delinquency during the grace period, lenders accomplish something powerful. They ensure that borrowers with any payment volatility get flagged in the credit system, even if they ultimately pay within the grace window. This serves the lender's risk management because it identifies which borrowers are most likely to eventually default. It also, conveniently, ensures that these borrowers refinance, if at all at higher rates, making the lender more money. I'm not suggesting conspiracy here. I'm describing how a system designed to be profitable for lenders inevitably punishes borrowers who don't understand the mechanics. Here's what compounds this problem. Most borrowers don't have one mortgage. According to 2024 data, the median home price in markets like California is $823,000. In more affordable markets like the Midwest, you're looking at $287,000. But if you're an investor like me, you're managing multiple loans simultaneously. I have 30 properties. That means managing 30 different grace period windows, 30 different reporting schedules, and 30 different lenders with potentially different procedures. One grace period slip on a property in my portfolio could trigger a cascade. My credit score drops, my debt-to-income ratio gets evaluated differently on my next refinance, and suddenly I'm paying an extra quarter point on a $1 million commercial acquisition. That's $52,500 in additional interest over 7 years. For investors, grace period abuse isn't just an inconvenience, it's a portfolio killer. So what's the actual play here? How do you protect yourself? First, understand that the grace period is a tool, not a guarantee. It's not a free pass to pay late. It's a contractual mechanism that prevents late fees for a limited time, period. Second, never ever rely on grace periods for cash flow management. I've built my portfolio on a simple principle: cash reserves equal optionality. I maintain 6 months of operating expenses across all 30 properties in dedicated reserve accounts. This isn't because I'm paranoid, it's because I've seen what happens when someone doesn't. The grace period becomes a crutch and then a trap. Third, if you're going to use a grace period, and I mean if you absolutely have to, do it strategically and minimally. In my experience, using a grace period more than once every 24 months is a red flag on your credit profile. Lenders see patterns. Multiple grace period usages signal instability, and they'll reprice your risk accordingly. Fourth, understand your specific lender's timeline. Call them. Ask exactly when they report delinquencies to the credit bureaus. Don't assume it's on day 30. For some servicers, it's day 25. For others, it's rolling daily. Know your specific lender's process. Fifth, if you're planning any major financial moves, refinancing, taking on new debt, applying for business lines of credit, never, ever let a grace period hit your report in the 90 days before those applications. A recent delinquency, even a reported one within a grace period, will cost you substantially in rate adjustments. Last point, if you're investing in real estate seriously, treat credit management as a core operational discipline like accounting or tenant screening. I have a credit monitoring service for all 30 properties, and I review reports monthly. I know immediately if any lender is reporting anything unusual. This proactive approach has saved me hundreds of thousands in rate protection. The housing market is competitive. Whether you're buying a primary residence or building an investment portfolio, your credit score